Good morning, everybody, and a warm welcome to you. Thank you so much for joining us this morning for this first in the series of ETF Strategic Technical Workshops. So delighted that you could join us this morning. Thank you very much. We are delighted that we have Professor Crawford Spence from King's Business School, who's going to lead the session this morning on finance in challenging times. I'm sure that's something that is very important to you all this morning, so thank you for joining us. We also have Phil Cook, who is an ex-CEO of many colleges. He's led many institutions, predominantly in turnaround times. So we've got Phil, who's been supporting us on this ETF project. Just a couple of minutes from me before I hand you over to Crawford to introduce himself. The first thing is we are recording today's session, the tutorial parts. We will not be recording those discussions that take place in the breakouts because we want those to free flowly. So feel free to have those honest conversations, but certainly the tutorials will be recorded. And so we know who we've got in the room, could I just ask you to put your name, role and your institution in chat for us, please, whilst we're handing over to Crawford, and then we know who we've got in the room. I think that's everything from me. So our camera on if possible, if you can permit that, please, that would be lovely so that we can see you. And then I am now going to hand over to Crawford. Enjoy the session. Thank you. Crawford.
Thanks very much, Jane, and thanks very much to Phil for joining us as well. Phil will use as a sounding board at various points in the session, particularly in the second hour, where we'll do a live case study of Macclesfield College. So thanks very much. I'm just going to share my screen now, and if I could ask everyone to put themselves on mute for the time being, there's a couple of people who had some feedback coming through from. Hopefully you can all see that. Well, that's on, I need to put on slideshow, don't I? There we go. Okay, that's great. Yep, I just need to get rid of some of these pop-up things that are appearing on my screen rather annoyingly. And then we're good to go. Okay, perfect. Okay, so I'll introduce myself briefly, give you a brief schedule of what we're going to get through in the next 2 hours. I'm trying to get through quite a fair amount if we can, and then we'll just launch. Okay, so I'm based at King's College London. I'm a professor of accounting, but I'm more of an economic sociologist really, which means I'm interested in the behavioural aspects of finance and how people respond to financial figures and how they use financial figures in order to enact strategy, if you like. So it's more than just the technical stuff, which I think is always useful for these sorts of sessions. I have a broad range of research interests, which I won't bore you with just now. I am also a chartered accountant. I lived in Canada a few years ago, and I got my articles over there. I lived in various places, and in terms of delivering finance courses to executive audiences, I've got a range of experience there as well. And obviously I've had senior leadership positions in the HE sector. So it's been interesting over the last couple of weeks preparing for this session, doing compare and contrast between HE and FE. There are obviously a lot of differences, but there are quite a few similarities as well in terms of some of the long-term secular trends that you guys are facing. And a lot of negative trends as well that we can both cry over together. Okay, so as I said, I'm going to try and get through quite a bit over the next 2 hours. I'll be breaking you up into breakout groups about three or four times. So please be prepared to speak to each other. It's, 2 hours listening to me will be a little bit tiring. And in any case, when we're delivering executive programs, we always have this concept of the cross-fertilization of knowledge. So there's only so much you're going to learn from me. You're going to learn at least as much from speaking to each other as well. So in many respects, I'm here to try and orchestrate a conversation between yourselves and sharing experiences from people from different parts of the FE sector in terms of the financial challenges that you're facing and the financial opportunities that you may or may not see. Hopefully is something that we'll bring to the surface today, and you'll be able to take away from the 2 hours that we have together. So, I've set myself this objective. It's going to be hard to achieve that in just 2 hours, but I do think it's possible to, improve your confidence a little bit in terms of financial literacy, and to help you think through perhaps, some of the main strategic decisions that leaders in the FE sector are facing, and how maybe different decisions might be made given the financial reality that you're all facing. Yeah, so this is in 4 sections, if you like. We're not going to have any break as such, but obviously, if you need a comfort break when we move into the breakout rooms, and you'll be in breakout rooms for say 5, 6, 7 minutes at a time, you have the opportunity to do what you need to do then. So these are relatively equal segments. I'm going to spend a little bit of time as a prelude talking about the nature of financial figures and trying to demystify them for you, then talk about the importance of expertise in an FE context, and indeed in any context. Look at some broad sector trends that are impacting the FE sector, particularly on the recent Institute for Fiscal Studies report. And then finally, we've got this live case study looking at Macclesfield College, which is, broadly representative of many FE colleges, sort of mid-size, Ofsted rated goods, experiencing a financial pinch in various areas. And they've gone through a recent initiative to try and, balance the books a lot better. And Phil's spent a bit of time talking to them as well. I'm going to look at what they've been going through. I'll go through their financial accounts a little bit with you, and then discuss whether their strategic initiative is likely to, bear fruit in terms of the financial results they're wanting to see, and to think through as well whether that may be an option for your own institutions as well. And again, that sort of cross-fertilization of knowledge, discussing, comparing and contrasting across different FE colleges and institutions will be something that hopefully is quite useful for you. Okay, that's what we've got to do. Unless there's any questions, please raise your hand at any point or put something in the chat. If I miss it, Jane is there to keep me on track, and we will try and get through this as best we can. Okay, so first thing I want to get across to you is numbers are important, but they are not cast in stone. They are not in concrete. You need to be able to view these as socially constructed. Okay, so I've just got a couple of very brief vignettes for you here to go through, and some of you will have experienced this in management accounting meetings, or weekly meetings or monthly meetings where you're having to go through management accounts. Often figures are presented as if they're gospel, but actually they're not. There's a lot of inherent subjectivity and decisions that go into the construction of financial numbers. And I'm not trying to get this across to you because of some obscure philosophical attachment to, to the nature of accounting, but just in a very concrete, nuts and bolts, practical fashion. If you know this stuff, if you know that numbers are to some extent made up, then you can challenge them, and you can also make different kinds of decisions on the basis of the numbers that are presented to you. And that, I think, is very important. So one area that's an easy way to illustrate this point about the sort of slippery nature of accounting is overhead allocation. Yeah, so let's take a building. This could be a university, it could be a college, and the building contains 8 floors. It's sort of loosely based on my own building where I work in central London, but it could be anywhere really. So the building contains 8 floors. And the organisation pays £2 million a year in lease costs. Okay. Now the challenge internally is to allocate those lease costs to the 3 different units that populate the building. So we have a business school, which takes 4 floors. We have the computer science department, which does different sort of things. They have a lot of kit, for example. A lot of hardware, much more than the business school, and they occupy 2 floors. Different kinds of energy consumption, different numbers of employees, and then there's a cafe as well. One on the top floor, one on the bottom floor. So anyone who's been to Bush House in central London will be able to picture this in their mind's eye, but it doesn't really matter. So there are different options there for how we might allocate this £2 million. What the accountant needs to do is to identify the most appropriate overhead allocation base, they call it, the best method of parceling up this £2 million. Now they can do it via number of floors occupied, which is a sort of relatively straightforward way to do so. They could do it by square footage, which is not exactly the same as number of floors occupied, because there are some common areas and some floors that you can't allocate to certain places. So that would be a slightly different way of doing it. You could do energy consumption. So, you know, again, these different units behave in different ways. So energy consumption could be used as a proxy for the allocation of this overhead, or you could use number of employees, which again, you know, is an indicator of the amount of activity or footfall or throughput that you're going to have in that particular place. You can see that whatever result you go with, you know, you're going to end up with different costs that are allocated to different units. So, you know, there's quite a lot of us on the call now, so it may be best to put some ideas in the chat. If you have any views on what you think is the best one, maybe just briefly put them into the chat and with a very brief explanation as well, and we'll gather some ideas via that. Anyway, we have here allocate square footage. This would be the cost driver. Okay, so that someone's, you know, using the right language here. What's the cost driver? What's actually driving the lease cost here? Fiona's in square footage. So is Jane. Does the lease include the energy costs? Currently assuming that they're separate. Yes, let's say they're separate. Employees, square footage. Preference would be square footage. Number of employees. Okay, but nobody's saying why, other than Jane, who mentioned the notion, or sorry, Fiona, who mentioned the notion of the cost driver. What's actually driving the cost here of the lease? Is square footage driving the cost? Is that the best correlation we're going to get? Yeah, I'm being slightly cheeky here, because there's no correct answer. Yeah, I mean, allocating overheads in an FE environment, in any environment, is an entirely arbitrary process. Maybe not entirely arbitrary. I mean, you need to have some sort of rationale for what you're doing. Some sort of cost driver needs to be identified, but there's no perfect one. Yeah, any of these you can argue for or against. You know, you can suggest that number of floors occupied is as good as you're going to get, but then you could say energy consumption is more fine-grained in terms of, you know, the actual usage of the building. But then equally, you can argue against that, saying it's more about the number of people that are passing through there. So employees, which maybe is reflective of also the number of students that you're going to have passing through those particular floors, is fair enough. But then you also have shared areas as well, which everyone is using. So, but you can see that what happens here is going to produce quite different figures, depending on which allocation base you end up choosing. So, and that's important, because you might end up using that information to calculate whether or not the business school makes a surplus or a deficit versus whether the computer science department makes a surplus or a deficit. Yeah. And particularly if you're going to set prices or fees on that basis. Yeah, I know fees in the FE and HE sector are regulated to a large extent. I mean, there's some discretion in both cases to flex those things for certain programs. So prices might be set on the basis of these figures. So, you know, you need to know whether or not you should be charging, you know, £4,000 a year to a student or £8,000 a year in order to recover your costs. And that's a real challenge for people, because there's no correct answer here. However, what happens, and I see this time and time again, budget meetings, is figures are presented to people as if they are objective and as if they're concrete, but they're not concrete. The only concrete figure there really is the £2 million that you have to pay to the building owner every year. Whatever you do with that internally is a management choice. And, you know, throughout the course of my career, I've, you know, whenever I've been in sort of in decision-making roles, I've spent a lot of time trying to challenge figures as well. And, you know, that's not just because, you know, I'm an accountant, although it probably helps me, but it's because I recognize the arbitrary nature of these figures. And other people who are not grounded in accounting in the same way that I am can do the same thing as well. So if someone's presenting to you information suggesting that your department is a cost center rather than a profit center, I mean, I would ask them to see the assumptions upon which they are making that statement, because you could shake that and lots of different things would fall out from it. Yeah. So, these overhead allocations as a broad sort of microcosm of how accounting works in general, I think suggest that financial figures are problematic. And this works in other environments as well. Now, we'll share these slides with you after the session. So we've got a college receives a training contract from industry, okay? And it's worth £5 million over 5 years. Yeah. When will they recognize the revenue in their financial statements? They've got annual financial statements, a profit and loss account. Well, when will that revenue be recognized? The first year, the last year, over time? When do you think that will be the case? Again, if you just throw some broad ideas in the chat, it'll be useful for me to see what people's thinking is on this particular topic. Depending on whether there are any delivery milestones in the training contract every year over the 5 years. Okay. It depends on the terms of the contract, targets set each year, paid at various intervals and installments. In line with how the expenditure for the project would be recognised. I think Fiona's an accountant, you know that. And there we go. In line with planned delivery. Okay, so there's some. I mean, these all make sense. And to some extent, it's the same as overhead allocation. You have different options here. Yeah, but you need to remember it's not the same. Recognizing revenue in your financial statements, a sales figure or an income figure is not the same as when you actually receive the cash. You can recognize it before you've received the cash, or you can recognize it way after you've received the cash. So you have all of these different options. Okay. You have when the cash is actually received. That's actually the least likely. Most people go to this as the first port of call, to think that, well, you receive the money, you recognize the money as soon as you receive it. Accounting doesn't work like that. Accounting doesn't just, you have a cash flow statement, which does that for you. But most time people ignore the cash flow statement or pay it very quick attention and then spend more time on the profit and loss account and the balance sheet, which are full of all sorts of decisions and judgments and somehow correspond less to reality, but they're supposed to tell a bigger truth. So you could do it when the cash is received, but in practice, that would be the least likely, I would say. In installments, yes. I mean, I think that's quite likely. So maybe 50% upfront and then 25% after a certain time, then 25%. At the end of the contract, that would be a very conservative, small c, way of recognizing the revenue. Because if the contract is not completed, they could always ask for the money to be paid back. So a very conservative way would be to recognize it at the end of the contract, but that would be unlikely in this scenario because it sounds like it's a relatively sure thing. So you should book it once you think it's pretty much going to happen. And this is what I think Fiona Yardley was suggesting, you do it in relation to the expenses incurred. So in the accounting world, we have this concept called matching. You're supposed to match revenues with expenses. Yeah. So again, expenses are not cash outflows. Expenses are costs incurred, which could take the form of a debt that hasn't actually been paid yet. So the whole idea there is you would recognize this £5 million in installments, but specifically in installments in correlation with when the work has been done. So if you're doing 50% of the work in the last year, then you would probably recognize 50% of that 5 million, 2.5 million in the last year. It doesn't really matter when you receive the money. It could be at the beginning, it could be in installments, it could be at the end. What you show in the financial accounts is very different from what actually happens in terms of cash changing hands. Yeah. And that's the principle of accruals accounting. So again, what you see there are financial figures that are to some extent made up is probably too strong a phrase, but they are, again, there's a lot of judgment that goes into identifying what is a particular revenue or a sales figure. It's supposed to reflect the underlying economic reality, but you see, that's not an objective thing. This is not scientific principles that we're working on. And to be good at accounting, I always tell my students this: you don't need to be good at numbers. There's nothing to do with numbers. You've got calculators to do the technical stuff. You need to think about these judgments. What is this related to? So you need to have a knowledge about how the organization operates and when this work is actually going to be undertaken for industry. When are these courses going to be developed and delivered? So it's a management issue rather than a sort of technical accounting issue. So, hopefully that demystifies things a little bit for you. And obviously, depending on which approach you take here, the financial statements of the college are going to vary quite widely. So it's important. It's important. And you see lots of financial scandals with chief executives trying to get bonuses in the private sector because they try and book sales too early, or they try and book sales late in order to smooth income and show themselves in a favorable light at a certain point in time. And accounting affords people that level of discretion. Actually, auditors are supposed to hold you to account on these things, but they don't always do such a great job, and they have limited bandwidth as well. And in fact, if you look at financial accounts, certainly in listed companies, financial analysts who work for investment firms, they sort of almost ignore the financial accounts, go straight to the notes to the accounts and rewrite the accounts on what they think is a more appropriate basis. And we'll see this later when we go through Macclesfield's accounts. I mean, I spent a few minutes looking at their financial statements, and I spent a lot more time looking at the notes to the accounts, trying to understand what is actually happening in the background. So it's what's happening in the background that's important with figures. And if you just take figures that are presented to you at face value, you're going to have other people making decisions, okay? And you're not going to be in a situation where you're empowered to make decisions yourselves. You need to try and get behind those figures as much as you can. And I appreciate there are challenges there with getting information and probing people too much. But if you can get behind those figures, you're going to be in a much stronger position upon which to make a case for whatever initiative you're trying to advance, or to suggest the organization chooses course A over course B. So this is my first sort of key insight, if you like. This is an art rather than a science, and accounting is all about judgment rather than numbers. And again, this is not just a philosophical statement. This, I think, is a very practical insight. And if people recognize this more often, we would have less financial scandals. We would have less things like Carillion, less things like Wirecard or Enron, for anyone who's older, my age or older, who would remember Enron, because people would not take financial figures as if they were, trustworthy. You would look at them and you would interrogate them in much more detail and realize that they're all hanging on a shoegly peg, as we say in Scotland. But that doesn't mean they're useless. It just means we have to treat them with a very healthy dose of skepticism. And it doesn't take much financial knowledge to be able to do that. It just takes a broad awareness that almost everything that's presented to you, particularly in management accounting meetings, is going to be based on a lot of judgment. And you need to just ask people, what are the assumptions they've been employing to produce those figures, and are they appropriate? Okay, I got a few broad things now to say about financial expertise, and then we'll break out and have a discussion amongst yourselves. Okay, so I mean, you're here on this course and other courses obviously because you're recognizing the importance of accumulating different kinds of knowledge and rounding yourselves out as professionals. And I guess I'm just going to reinforce the importance of this, particularly from a finance point of view, with a couple of examples from different places, showing how financial expertise is becoming more and more important across different sectors. Yeah, so there's a lot of literature on the NHS, which has looked at the rise of the hybrid manager, and this would work in an FE context as well. I certainly see it happening in an HE context, where you have people of a professional background, moving into managerial roles. And now, particularly in the NHS, these people who are a sort of hybrid, if you like, they're not pure managers, they're not pure clinicians, they outnumber pure managers. And that's a challenge because they have to reconcile their sort of professional identity, you know, what they were good at for 10 or 15 years with their new managerial identity. And in order to do that, a key thing that comes out of this book and other literature on the topic is that finance plays a very important role in helping bridge those different divides, those different disciplines, and in rounding people out as professionals as well. And, you know, look, I do a lot of work studying different professional groups, mostly financial professions, but have looked beyond that to different places as well. And we can see that being a leader in a professional environment, you know, and there we can look at, you know, certainly FE within that context. To be considered legitimate, you need to have knowledge of the core business. So, you know, certainly in HE, you know, you don't see many people who are vice chancellors who haven't been very successful research professors as well. There's the odd case of people being sort of a pure manager coming in from outside. That tends not to always work all that well. I'm not sure exactly what's happening in FE in terms of the recent trends in this respect, but I'm sure you have similar dynamics where the legitimacy of leaders is built on knowledge of the core business. However, you know, being good at, you know, teaching metaphysics to students doesn't make you good at running a university. Yeah. And the same is true in an FE environment. You know, you need to have a broader skill set in order to occupy a managerial role. And that, you know, one key element of that is obviously financial expertise. And if you look at broader trends in the economy, we can see that this has grown over time as well. So, you know, a slightly different environment, but, you know, there's a big literature on the background of chief executive officers. And, you know, most of this stuff is drawn from the United States. And we can see that the change in background of chief executives in the United States tells us something about the way in which organizations, I think, are run more broadly. So in the early 20th century, chief executives in the US mostly came from manufacturing, yeah, or they were entrepreneurs as well. And that was reflective of the sort of economic base of society, sort of the industrial base of society. You hit the mid-20th century, things move more towards sort of service-based economy to some extent, you know, so it starts being sales and marketing that start to become the key things. You know, that's the key constellation of expertise that you see among chief executives in the United States. You reach the end of the 20th century, and almost all of them are experts in finance, or a majority of them at least. Which I think is interesting. And that doesn't just say something about, you know, listed companies in the US. If you compare this to literature and lots of different sectors and geographies, you're going to see that financial expertise has grown in importance quite significantly. You know, those first 2 points are not that relevant for this audience, but it's, you know, the importance of accumulating financial expertise has increased over time, and particularly you see this with organizations that have experienced poor performance. And poor performance might be the fault of the previous chief executive or senior leadership team, or it might just be a result of chronic economic conditions in the sector. And, you know, when Phil comes in later and talks to us, he might have some reflections on this, you know, himself having had experience of sort of trying to turn around organizations that have been struggling financially. So financial expertise is not just something that's a useful thing to have or a bonus. It's becoming a real essential for anyone who moves into a leadership position in any sector now, because finance is so strained. So yeah, so just to wrap this little section up, and then we'll move to, I've got some questions I want to ask you guys in breakout groups. So financial expertise has become more important over time in general. It can't harm to have more of it, but how you deploy it does require, I would say, savvy and a feel for the game as well. I'm telling you to go in and start interrogating your financial director about how he's allocating overheads. There's obviously a way in which you would go about doing that, because all strategic maneuvers are situated and contextual. So, you know, how you apply that financial expertise, and you don't need much of it. You know, you need a little bit of financial knowledge can go a long way, actually. Requires probably, you know, sort of political savvy and political acumen as you go forward. I can come back to these issues, but for the time being, have a couple of discussion points that I want you to go into groups for a few minutes to discuss. And then, maybe elect a spokesperson who's not a shrinking violet, who can feed back to us very briefly. And we can maybe synthesize some of these insights before moving on to the next section of the session. So yeah, first thing, have you ever used financial arguments to persuade colleagues or decision makers to buy into your plans? Has that been successful? Has it not been successful? Do people glaze over when you start talking figures? Has that been useful to you? Has it not been? So that's an interesting question, and often something that I find a lot from the various institutions I've worked in is FD turns up at meetings and tries to hide behind financial jargon, and then as soon as you start interrogating him on it, you realize things could have been constructed really quite differently. So to what extent have you experienced this as well, and what do you think you might do about it going forward? Without obviously trying to commit career suicide in the process. So there are 2 questions. I'm going to put you into breakout groups now.
Well, I think we're all back, Crawford.
That's great. So yeah, we're up with 4, 5, and 6 now. So if someone from group 4 can offer up a sacrificial lamb, that would be much appreciated.
Hi. So I'm from group 4. The main challenges coming out of our group, the common themes where we're discussing about energy prices. Obviously that's the same for all businesses at the moment. Obviously we're seeing massive hikes in those prices. Also wage increases. So a lot of other organisations are sort of increasing wages for their staff, which is something we struggle to do as a college. And Jane, we were talking to as well, saying that she's from a college near London, and of course you're competing with London salaries. And the other thing was working from home. So a lot of other industries at the moment are offering working from home, which again is hard to do when you're a college and you've got students on campus. You need to have that presence there of staff. Moving on to the reclassification of the public sector, we were saying that at the moment the changes that we anticipate taking place is a change in financial year. Colleges have got less control over their own finances, so unable to go out and get loans other than seeking that from the ESFA. Less control over capital projects, and also being unable to sell property. Those were the main themes that we took from that discussion. Yeah,
okay, interesting. Yeah, so that's very, very helpful, and specifically honing in on the financial aspects there as well. Okay, what about from group 5? Have you got any additional points that you discussed? Anyone from group 5?
Sorry, I'll help. It's Ronnie. I was just having a coughing fit, so I'm really sorry. I'm from a HR background and my other colleagues are finance background, so we had quite a good debate. Key challenges, like everybody else, is increased staff costs with wages and also agency costs as well that have gone up. And sorry. We talked about the fact in trying to fight them. This college has gone to an on campus sort of 4-day week and 1-day remote working to try and help with the energy bills, which is proving quite good for this college at the moment. We're doing a staff poll with everybody on Friday to look at that. We've also looked at the fact we've set up a resource approval meeting, so having very close scrutiny with senior leaders and finance directors and HR, looking at invoices, purchase orders, income, outcome, and what is going on with our budget and our finances. And it's much tighter focus this year than other years. We didn't get to question 2, so yeah.
Okay, no, that's fine. In terms of wage increases, just for my benefit, so that I can tailor the discussion later, have you, wherever you work, has there been a local wage increase, or does the whole thing, is it all collectively bargained with the union? Has there been an agreement?
Yeah, we're collective bargaining with our unions. They've put, much like any other college, a 10% wage increase, and we're in the middle of pay negotiations at the moment, and there's no way we can meet their pay claim this year.
Yeah, sure.
But agency costs as well, we were saying that's near enough doubled for some specialist technical roles. It's increased. A couple of years ago, agencies were like £35 an hour.
Yeah.
Engineer the other day and a plumber £60 an hour if you want to cover teaching costs. So yes, we're looking at all sorts of different increases across the board from everything that we purchase.
Yeah, okay. No, thanks very much. That's helpful. And it sounds like things that everyone else are going to be experiencing as well. But you said you moved to a 4-day week. Did you say that, or did you say you introduced working from home?
Sorry, what was that?
No, you said something about did you say something about moving to a 4-day
Yeah,
week?
we've condensed our teaching across the majority of our campuses into a 4-day week, and then have 1 day remote working.
Okay.
We still keep 2 of our colleges open for apprenticeships and some people who do still wish to work and come into college. Okay, no, that's fine. So it's similar to what Macclesfield have actually proposed. Yeah. So we'll be able to discuss that in the next segment. Okay, great. So just to wrap up this section, Group 6, could you offer some insights, please?
Yeah, I'll happy. I was asked to speak on behalf of Group 6. So in addition to what's already been said, we picked up on the fact that there's inequality in funding for FE compared with school sector. But then, of course, the school we have in the FE, of course, we have the capacity to go out and generate more income, whereas schools don't really have that capacity. But then the point that we then got on to discussing was the fact that there's oversupply of places in the sector. Hence, that's why most colleges could easily accommodate more students in their facilities. And although we are supposed to be working collaboratively, in fact we're working in competition, because of course we all want to tap into the same pool of school leavers and young people and adults, and that is causing financial problems. I mean, you mentioned earlier when you started teaching you taught 4 students. Well, of course, that sort of thing in a class isn't possible. We're very much focused on class sizes.
Yeah. Which helps balance the books, but there's a challenge there, or a corresponding impact on quality experience as well, isn't it?
And then just taking from the previous discussion, again, it was staff utilization was the main theme. Colleagues were saying that they were expected to have staff utilization of sort of 96-97%, and that can be very difficult with timetables to get all of your teaching staff fully utilized.
Yeah. Okay, that's great. Thanks a lot, Kevin. Very, very much appreciated. So that's some interesting insights there, and I think paints a picture of a sector that's experiencing financial strain, and particularly energy costs has impacted people, and people want to get paid more, and colleges and sixth form colleges are struggling to find the money in order to provide those or meet those demands. Okay, so we'll try and collate some of these insights now as we move towards a sort of particular case study, and we focused here on Macclesfield College for a couple of reasons. One is that I think they're probably an easy enough college to understand, and also they've undergone this initiative of moving to a 4-day week, slightly different from I think what Ronnie's talking about. They're not doing a working from home on a Friday. They've actually I think moved to a 4-day week for most people, as a way to try and save costs moving forward. So I'll give you a brief overview of the college, highlight some key financial data, maybe ask Phil to come in and ask offer a little bit more colour on what's going on, because he interviewed the senior leadership team there the other day as a way of helping us prep for this session, and then we'll put you into discussion groups to see what you think the impact of this 4-day week is going to be specifically on their financial profile. So it's Ofsted rated good or grade 2. They've got about 3,000 students. I think this makes them a sort of medium-sized college in the FE sector, split across different sorts of programs and age ranges. And reading their strategic report, the board highlight a number of key concerns. One, their key concern is that staff can actually continue working, which sounds rather distressing. I mean, I don't recall reading a strategic report that actually raised that in such stark terms. 2, that they've got sufficient time to secure new funding. And thirdly, that they have sufficient resources to meet liabilities. So, none of that sounds particularly positive. But when you look at their accounts, they don't actually look all that bad overall. So this is just some sort of key financial data. I'll go into the financial statements in a little bit more detail. Don't worry, I won't bore you to tears with it, but I'll just highlight what I think are some key trends. So you've got on the left-hand column there, their target for the last financial year. I guess this was 21-22. And the actual results as well. So the student numbers ended up being a bit lower than they had hoped for. Their current ratio was much lower than they had hoped for. So their current ratio was really current assets, what you have at hand, versus current liabilities, what you owe. I mean, that should always be more than 1, really, as a sort of standard rule, and anything above that is good. I mean, they had a target there of 3.1, which looks very conservative. I mean, arguably that's too conservative, depending on your perspective. And actually, it was 1.5, so they're off target there. Whether that's the right target or not, though, I'm not sure. Some of you who are FDs will have different targets and different views on that. Their EBITDA, which is their earnings, a sort of flushed out, cleaned up earnings income figure, if you like, focused specifically on education, taking away some things which don't correlate directly with educational activity, like depreciation and amortization, which are kind of made up figures to some extent, and interest and tax, which again, might be separate from the actual educational activity of the institution, was quite significantly below what their target was as well. So 8.45% versus 3.41. Their debt percentage to income was pretty much where they needed to be, slightly higher, but not significantly so. Their financial health grade, which presumably that comes from Ofsted, was good, whereas they wanted it to be outstanding. But good doesn't sound, it's not bad, right? Their debt service cover was fine, so that there's no significant distress signals being sent to those they owe money to. Current liabilities maybe is a bit of an issue, but in terms of them being able to cover their interest payments and debt contracts, that seems to be okay. Staff costs as a percentage of income. Now, this is interesting, and this feeds back into some of the issues people have been talking about, wage increases as well. And Phil was telling me a few days ago when we were talking about this, the norm in this sector is to have staff costs hover somewhere in the 60 percentage points mark. I mean, in HE, it's a bit lower than that. It's about 55 to 58% historically as staff costs. So we can see that I think Macclesfield is, as far as I understand, broadly representative of the sector, and being round about 63, 64%, and that is within their target. They want to be less than 65%. And we'll come back to this issue when I look at the income statement in a minute, because we'll see that a big wage increase would push them way up into the 70% category. They've got enough cash floating around as a buffer, and they've got over 25 days cash in hand for all months of the year. So, in terms of being fiscally conservative, they managed to tick those boxes. So it doesn't look too bad, but overall income's a bit of an issue, and working capital, current assets over current liabilities, is something that they need to look at. So, this is the profit and loss account, otherwise known as the income statement or statement of comprehensive income. It has these different names, but let's just call it the P&L. And, just highlight a few key trends for you there before you go into discussion groups. One is you can see the funding body grants have increased. We talked about this increasing across the sector over the last couple of years. And so the total income for this, this organisation has gone up from 10.5 to basically 11 million from one year to the next. Most of that has been swallowed by increased staff costs, which I think is just a reflection of the natural growth of the organisation as it's tried to take on more students. But you can see there, if that's 63%, those staff cost figure of the overall income, if you then do give staff a 10% increase, that takes you up to about £8 million in staff costs, and 8 million over 11 million is about 73% or something like that, which is, you know, probably a bit of a problem for this organization or any organization to be spending so much money on staff costs. And, you know, in my sector, we're going through the same thing as well. You know, they offered staff 4 to 5% in an inflationary environment that's in double figures. And, you know, nobody finds that acceptable. But then you look at the financial statements of the organization and the income is not increasing particularly much. It's not going to increase by 10%. So you can also see it from the point of view of the employers, that if they start granting, you know, those sorts of wage increases without corresponding increases in income, it actually looks financially irresponsible and could cause them some problems in terms of things like debt covenants and relationships with creditors. So, you know, in some ways, this demand gets pushed further down the line towards government or other income sources, taking the form of, well, you know, we can only increase staff costs if we have corresponding increase in income. So you can see the rationale for that. You know, I'm employed, I want a 10% pay increase as well. And, you know, I'm annoyed when I don't get one, but I can also understand why we're not getting it. So yeah, I'm not sure what to say about that beyond that. Equally, it doesn't sound like a particularly sustainable situation. Overall, this organization has made a deficit, an increased deficit for the year, in terms of an operating deficit. Then someone went on with the pensions here. They've obviously revalued pensions and decided, I mean, I don't know enough about how pensions in the FE sector, but just from reading the financial statement, it looks like they've decided to massively reduce everybody's pension benefits. So their liabilities going forward are decreased. Therefore, this deficit they had is now turned into an overall surplus. But that's very artificial, because that's really just a sort of accounting decision. Well, more than an accounting decision, it's a decision about what to do with people's pensions. But it makes the organisation look much more healthy than it actually was. I mean, the pensions thing we can almost separate as another discussion. The key thing to look at here really is that 856 as an operating deficit. So the organisation is losing money, and, you know, quite a significant amount of money. You know, about 9% or something like that of its overall income is a deficit, which is obviously not sustainable.
Crawford, we had a comment in the chat about one of the colleges using a percentage for salary increase rather than, using an amount for every member of staff, which I think is quite a creative way of looking at that. And then decrease for higher earners. Yeah. I think, you know, and you see this across different sectors as well. I know there was some with public sector workers in Glasgow recently where it was. I think the employers wanted to pay a percentage, but the union wanted a flat amount, or actual amounts, because it was going to be more beneficial it was higher in percentage terms for the lower paid people. Yeah, so I think that's a lot of the responses from employers are starting to take those sorts of those forms now as well. Okay, so the balance sheet. The balance sheet shows what the organization has versus what it owes. Some people think it shows the value of an organization. It doesn't show that. I mean, a lot of the assets there are at historic cost. I mean, the buildings there, that's not the market value of the buildings. And in any case, you know, being part of the public sector now, don't have the discretion to sell these buildings, someone just said. So, you know, my old PhD supervisor once said to me, you know, I've been an accountant for 40 years and I've no idea what the point of a balance sheet is. He was being slightly facetious, but not entirely. Sometimes I do wonder what it's trying to achieve as well. It's useful to assemble different account categories together, but overall, what does it actually show you? It shows you what the organization has, what it owes, and where its funding comes from. But it doesn't show you anything really about value. Not on the face value of it anyway. Not on the face of it. You'd have to do other things to try and arrive at some value of an organization. Anyway, so, you know, mostly the tangible assets are embodied in buildings. You've got some debtors, people who owe them money, much less than people they owe money to. Okay, so, you know, one way of calculating a current ratio would be just to compare debtors and creditors within a 12-month period, in which case there it's less than 1 to 1, which is a problem. But this organization carries a significant cash buffer
overcome that. So their working capital, you know, overall is not as bad as all that, but still they still have net current liabilities rather than net assets, which is a problem for them. Yeah, and you see they highlighted that in their strategic report as well, as you know, their ability to pay creditors, and this is just within 1 year. They have other creditors there as well, is somewhat limited. So they need to improve their working capital and get more current assets or reduce those current liabilities somehow. They also have a significant number of long-term creditors, which looks like they have long-term debt. Actually, when you look at the notes to the accounts with Macclesfield, it's a bit more complicated than that. What's happened is it's a revenue recognition issue. So remember that discussion we had about when do you recognize the revenue? What they've done is they've taken money from, I think it's the government or some sort of training contract. They've received that early, but they've not performed the work yet. So in accounting terms, that would be called unearned revenue, and that creates a liability in the balance sheet. I always think it's not really a liability. You know, it's going to be money for them in the future. In some ways, it sounds like more like an asset, but that's the way you treat with that. That accounting treatment is. So that's like going to become revenue actually at one point in the future. So it looks like long-term debt, but it's not really. And okay, you can see the difference between the liabilities. The provisions have reduced massively from 1 year to the next. So there's obviously been some revaluation in the pension scheme and reduced benefits for people going forward by the looks of it, although maybe I'm wrong about that. And yeah, so at the bottom, it just shows, you know, this is another knock-on effect of the pension reclassification, I think. Anyway, so Macclesfield, right, they need to start generating surpluses. They need to have a better current ratio. Those are sort of key things they're trying to do in the short term. And their solution is to move to a 4-day week to try and save costs. Now, the question I have for you is just what difference do you think this is going to make to their financial statements? How is this going to help them generate more surpluses and have a better current ratio? And, you know, try and think about this in the context of your own organizations as well. Is this something that you think might be worthwhile doing at your institution? And somebody was also mentioned some version of this with allowing homework and at least on day 5 of the week. Okay, but before we put you into breakout rooms, Phil Cook, I don't know, you were there speaking to Macclesfield a couple of days ago. I don't know if you want to add any more colour or context to this, just so people have a bit more information to go away with.
Yeah, just a little bit, if I may, Crawford, just for 2 minutes. First of all, just to give my own perspective. So 20 years ago, I was a deputy principal responsible for curriculum, teaching and learning, delivered an outstanding Ofsted. And the principal at the time said, you can now be the strategic lead for finance. I had a very, very talented management accountant. But going back to Crawford's point about accounting being an art, not a science, and judgment not rather than numbers, I fought it for 6 months. And then it was a complete and utter revelation. And my position as a principal, and I've actually got my, or we've got my ex-FD in the room, so she'd either counter or otherwise this, would be quite extreme. And my position was, if you can't understand finance, you can't be a manager at this college. It really was that simple, because coming from a curriculum background, understanding finance just opened so many doors for me and enabled me to actually focus really, really clearly on teaching and learning. So just to add a little bit to what Crawford said, and perhaps add a little bit more around the rationale. So the chief exec's been in post for 7 years. She's considered by colleagues to be entrepreneurial and innovative, and actively seeks to bring best practice from the private sector, where appropriate, into her college. But the way they monitor student progress, teaching and learning, etc., is more traditional, i.e. it's what we would all be used to. Just to be clear, they talk about the 4-day week as something called new ways of working. The college are expected to work from home on Fridays. Other than estate staff, who use Fridays to complete maintenance. Teaching, as Crawford said, is completed Monday to Thursday. It's a four-day-a-week pilot at the moment and was implemented in the summer of 2022. The rationale why they were doing it is multifaceted, and I'll go quite quickly through this. It's a list of about 7 points. So there was learning from COVID, in particular the challenges faced by students in respect of behavioural problems, mental health problems, and returning to learning. As Crawford's drawn out, the cost of living rises. As again, Crawford's drawn out, increased overhead costs. There was a big factor around work-life balance of staff, and potentially they saw an opportunity to improve teaching and learning. They also saw an opportunity to put more structure into timetables, thus enabling students to commit to part-time work on Fridays. And they were curious about providing a USP compared to competitor colleges in terms of staff and student recruitment. The CEO said there was a perfect storm in a moment in time when you either did something or you carried on doing the same thing and getting the same results. Consultation commenced in March and everyone was involved, including governors, staff, unions, funding agencies, politicians, schools, businesses and universities. It's 5 months in, there's no definitive answers. The college is currently undertaking a cultural impact assessment to evaluate the success or otherwise of the pilot. Crawford, I don't think I'll say any more because I think it's for the group now.
Yeah, that's great. Really helpful, Phil, and thanks for correcting me with the fifth day. It's not a day off. They actually have expected to work from home, so similar to what we heard before. Great, and Phil will come back and help us orchestrate the discussion after this. So, I mean, Jane, if you can do the same thing now, we're at 10:35. Maybe 10 minutes for this as a discussion in breakout rooms, same size of groups would be good.
Thank you, Crawford. Over to you, Crawford.
Okay, great. So thanks very much. Hopefully that generated a lively discussion. I think it's always useful to have a live case. Conscious of the time, and Jane wants to say a few things before the end. So try and gather some feedback quickly. So if we can start at the top again, group one, do you have any views on what sort of impact you think this would have on the college, or indeed whether that's something your institution might benefit from?
Yep, I can feedback. We were group one. Actually, 3 out of the 4 of us are at South Essex College, and we are trialing the 4-day with the working on the 5-day, 5th day from home. So we were talking about pros and cons. There's no HE students came up and arose because of access to studios to work in. So that was where they're paying for a course. Sometimes they're frustrated they can't access, but nothing that we haven't. The impact on the FE students, they don't really know any different. So that was positive. Staff, because we're mid-trial, we're trying to monitor well-being. Some staff really like having the 5th day working from home, but then the impact on that is that they're doing really heavy teaching days Monday to Thursday, so it's just trying to monitor staff within that really and check and see what the pros and cons sit with where they are. But interesting. We were talking about whether any others colleges have trialed it, such as Macclesfield. Be interested to hear feedback from whether they liked it, didn't like it, etc.
Yeah, okay, great. Thanks very much. Maybe group 2, and did you think about how this would actually show up on Macclesfield's financial statements?
Yeah, again from South Essex, repeating what Emily's just said. The issue I think for us and for Macclesfield is I'm not convinced this is going to generate any surpluses. What it's going to do is reduce some of your costs. We were not driven by costs. We were talking about this in March, April last year. Much as Phil had said, it was prompted by the lessons we learned at COVID. It's prompted by the reality of FE timetabling, which is most study programs can be delivered over 3 days, in some cases 2.5 days. And the sympathetic timetabling will enable you to do that. We didn't want to be dragging staff from 20 miles away to come to college when actually there wasn't any reason for them to be there and they could work from home. Yeah. So there was that well-being aspect to it. It is not going to generate a surplus for us. And actually, in terms of new programs, and if we're in a position to recruit more students and deliver more programs for them, then, you know, a 4-day week might not be feasible because we won't have space for them. Therefore, we have to open up on a Friday. So the jury's very much out as far as I'm concerned on this. And certainly the unintended consequence, which concerned me right from the very beginning, was the impact on staff of teaching 24 hours a week over 4 days. And the solution to that, which we would like to move towards, is actually reducing that teaching commitment.
Is this what, sorry?
It's reducing their teaching commitment.
Yeah, okay.
But that will have a cost impact in and of itself, and we're not in a position to take on that additional cost yet.
Yeah, of course. Okay, great. Well, fabulous counterpoints. Thank you so much. Anyone from Group 3?
Yeah, I just want to add on South Essex as well, where our group was as well. So I won't repeat anything, but one of the things that come up in our discussion was, and Ronnie mentioned it earlier, we're doing a survey on staff shortly to get some real feedback, feedback just from around the room was that some of the support services are liking it. It's a good way of working for them. And for some provision, it works as well. In Helen's area, for apprenticeships, it's working. That the staff are liking it, they're getting that balance. But then just what Adam said, the points we were making about someone who's delivering mainly 16 to 19, it all being crammed into 4 days can be quite challenging, and when someone's off sick, cover can be very hard to arrange. So I won't add any more because but generally that we're getting some staff like it and others don't, and I think our survey will back that up.
Okay, that's great. Thanks very much. And maybe we'll take insights from one more group, unless they're also from South Essex College. Let's try Group 5.
I'll just mention something up from Group 5. We haven't done the 4-day week yet, although we are contemplating. We're looking at it from a slightly different angle. Last year we reduced our but that has come challenges because we got things like tuition fund grants, and we're finding difficulty in the timetable to fit them. So we might reverse back to 34. The other bit we are doing, we have got evening classes opening 3 nights a week. We're definitely going to go down to 2 nights a week next year.
And what impact would that have?
Just to save energy. That's the driving force. We're just going to condense the evening classing over 2, and I think we've already looked at it. And apart from one ESOL, we might have to recruit 1 additional ESOL lecturer. I think we can do it.
Yeah. Okay. So, you know, it sounds a pretty common theme here, like keeping the lights on and the heating, the radiators turning is a big problem for lots of different institutions. Okay, maybe just to wrap up, Phil, do you want to offer some brief insights in terms of what the impact has been so far for the college, and you know, focus maybe particularly, I mean, a lot of people are mentioning staff well-being, which is you know, obviously great and important, but in addition to that, maybe is there any concrete financial impact that Macclesfield have managed to observe so far?
Yeah, I mean, if I focus on the financial aspect and one other aspect which hasn't yet been mentioned, so they anticipate transport savings. They pay for student transport, and they estimate that at 100k per annum. They're expecting to see a saving in terms of their utilities of somewhere between 15 to 20%, because their estates team have dedicated time now on a Friday. They've been able to pretty much do away with the estates team overtime. One of the aspects that I didn't, these are just what they've told me. I'm making no judgment as to whether this is good or bad, right or wrong. One of the things that actually came out really, really strongly was the impact on staff recruitment, and that they see this 4-day week as being a really, really positive USP in terms of selling what they offer to both existing and new lecturers. and they see that as a real positive. The other thing to add is that they've ensured no member of staff is disadvantaged financially by condensing hours and changing working methods and so on and so forth. So that's literally what I should have said at the start, the CEO and the director of HR fed back to me.
Really helpful, Phil. Thanks very much. So you can see that, you know, the 15-20% utility savings, you know, that does have the potential to move a deficit into a surplus. Yeah, Adam's right. It doesn't generate new income, but, you know, if you save enough money, then you know, you can move into the black from the red. That being said, with energy costs going up so much, I think something else they said, Phil, was all these changes might just lead to them being able to basically eliminate the impact of the energy price rise. So
Yes.
it doesn't move them in the opposite direction, but there's still more than a lot of people are managing to achieve, right? Great. Okay, listen, we could reflect on that much more, but I'm very conscious of time, and I need to give a couple of minutes over to Jane to just to give you some information on the upcoming 2 modules. So I'm just going to give you one final recap here very briefly, and just to say, please feel free to get in touch if you want to discuss any of these issues with me further. Just Google me, I'm easy to find, and happy to discuss issues with you or financial issues that you're struggling to understand or your institution's going through on a sort of a one-to-one basis. No problem at all. I do find this stuff interesting. So, you know, we've looked at the importance of financial expertise and the increasing importance of that to those in leadership positions. We've looked at some broad sectoral issues to do with FE, and, you know, via the prism of Macclesfield, we've looked at how colleges such as Macclesfield and yourselves are trying to find innovative solutions to try and make cost savings as well. So thanks very much. I enjoyed spending these 2 hours with you, and I'll pass you over now to Jane to finish up.
Thank you very much, Crawford, and thank you, Phil, for your insights too. I didn't say at the beginning, but actually I work with ETF, Change School and King's on the TLPD leadership programme, which has been absolutely fantastic. And I can say to you that through all the last few months of buddy group calls where we get together and discuss the challenges, staff recruitment has been probably one of the biggest you know, headaches for FE. So looking at ways to increase brand to attract talent, I think and also retain talent is a really good thing. So thank you for that. Just a couple of things for me, if I may, and I'm going to share my screen. Just wanted to spend a moment just making you aware of the upcoming, let me just pop that through to you. There we go. A couple of new workshops also that we're running. I just wanted to share with you. One is the Resilience and Leadership Programme that builds on this. Again, talking about well-being. Clearly that starts with culture and leadership, so helping all organisations think through not only individual leadership but resilience, but organisational resilience, which we've been talking about a bit this morning. So that's 23rd of February. That will also be online, slightly longer, 9 till 12. And again, I've put the link into the chat if whilst I'm talking you want to do that straight away. So that's the one in February with Dr. Robin Klingler-Vidra from King's. And then we've got an in-person session in Birmingham at the Meridian Hotel near the NEC on the 30th of March in the morning till 3:30. And that will be a very dynamic, interactive session for the 5 hours, leading cultural change, as you can see, and navigating the changes in the FE sector, building on some of the work that we've been doing around the TLPD programme, I'm sure. So those are 2 more workshops that we are delivering on behalf of the ETF. So please do join us for both of those if you can. Just a moment about the 30th of March. That will be the afternoon where we start cohort 5 of the TLPD, the T-Level Leadership Development Programme, that spans a whole year. Rich curriculum of learning, change enactment team workshops delivered by King's experts, some peer group sessions which go down really well, where you come together in small groups and talk about your individual colleges. So a really good programme. I facilitate the breakout room, sorry, the peer group sessions with those individuals and really get to build a strong relationship. We've got some familiar faces on the session today. So unless you've got any final questions from us, I will bring this session to a close in a moment. Crawford, thank you again for such I think, a really pragmatic and useful, interesting session. So thank you for that. And Phil, thank you for your insights. as a practitioner in the field. We've got a couple of minutes, so please, I know Crawford said he's happy to stay around for a moment or two if you've got anything specific that you want to capture him whilst he's there. Anybody?
Yeah, I just wanted to say something. It's, you know, I was quite interested in the 4-day week because I was telling in my group that I was a bit against it and was a little bit worried. But I think actually listening to other people, it's because my worry was when we were discussing it, we were saying actually we would reduce staff salaries by the 20%. So actually that would be deemed a cost saving. But what colleagues have done is not that. What they're saying is actually we base ourselves in the colleges 4 days a week, and then 1 day a week we're actually not on site. And actually that could become more workable because all the corresponding savings with that. So what we don't want to do is, it's all very short-termisms, cutting 20% of people's salary. But I think if there was 1 day a week where people could actually work at home, and it might not be the Friday, it might be, that would then bring a different dynamic because of all the corresponding cost savings from the electricity, from everything else. So I think I now will go back to that meeting with a little bit to maybe put a different argument over that. Actually, this isn't about reducing our staff bill by 20%. Actually, can we look at other ways of doing that? But there just needs to be that flexibility that if we get more students in, we would then have to be flexible enough to say, I'm sorry, but you would need to come back on the Friday. So I just thought that was quite insightful. I think Phil wants to say something. You're on mute, Phil.
It's Marie, isn't it? Is it
Yeah.
Yeah, I only see you sitting there. Marie, I went to meet with Macclesfield, and I was in a very, very similar position to yourself. In I'm a bit, you know, I was a little bit cynical, to be honest with you. Now, they're early days, but actually the principal and the director of HR in particular were really kind of positive, and they're doing, I didn't mention their comms. They do extensive comms. They do something called temperature checks, which basically involves surveys and conversations and group meetings and stuff like that. And their view at the moment is that staff absolutely love it. Now, what they haven't tested, which was what colleagues, I think it's South Essex College raised, I did ask them about it, I did challenge them, is the condensing of hours and therefore the stress on the teacher, basically doing 24 hours in 4 days. Although I'm not sure how many teachers in my experience actually teach that full 24 hours, but there we go, that's a different subject. And they weren't picking up signs at the moment, because what they were seeing was that their teachers in particular do all their prep and planning on the Friday. They don't seem to have meetings on a Friday. They do all their prep and planning, and then they've got the weekend free. I can't see whether that's, you know, I was a principal myself. A principal has a certain view of their college, and it's not always 100% accurate. Let's leave it like that. But they were talking about how positive. So I did test on condensing of time. I did test on challenging of losing a day for timetables. And I think a colleague called Helen, who manages apprenticeships, raised that in respect of endpoint assessments. And it really felt good from their perspective. It really did. And if the savings they're going to deliver, then that can only be a positive thing, whatever the economic landscape lies. So I walked in being a little bit cynical, but very, very interested. And I walked out thinking, oh, wow, okay, this is actually really, really interesting.
Yeah,
But they have said, Marie, that it probably won't be for me, it'll be for ETF. For ETF to go back in 6 months' time when they've done this massive cultural impact assessment and see how it sits then. But at the moment, my sense would be they will definitely continue because all the results are kind of suggesting that. They were talking about the estate looking absolutely fantastic because the maintenance, the estates team, basically have got no students around, so they can just make it. So I think it's interesting.
Yeah, it would be worth like maybe getting a group of people together just to discuss this in more detail and doing some benchmarking. I mean, we've got 1,800 staff, so it's a massive, real change for us across all of our colleges. But transportation is really, really expensive. And if you take 20% off of just all your fuel so it has got some benefits. My only worry was I was not comfortable about reducing stock by not paying additional money and saying, well, actually, that's it, 20%. That to me doesn't bode well. I think it's a bit short-termism, but it'd be interesting to speak to, I mean, Macclesfield isn't far from me anyway, so it'll be interesting just to see other colleges and to test this. So yeah, it was
I mean, what they said, Marie, was no staff members disadvantaged financially, where appropriate, condensed working hours are implemented, particularly for catering staff, technicians.
Yeah.
And cleaners, I guess, would be in there as well.
Mm.
And Marie, you've got a kind offer to talk to Adam, who says that he's happy to talk to anybody. So maybe connect direct. Right, we've burnt our voucher. I think it's 5 past the hour. Is anybody else? It's lovely to have you still with us. So I feel like Fiona Bruce here. Next week will be. Does anybody else want any other questions for Crawford or Phil while we're here? No? Then I think we will say again, thank you so much for joining us. It was a really rich conversation, and we look forward to seeing you next month. Hopefully you've taken a minute to book on to the next one. We look forward to seeing you there. Thank you again. Have a lovely